Okay, so you want to own a hotel. Maybe you've looked at the average nightly rate for a nice property in a busy city, multiplied it by 200 rooms and 365 nights, and landed on a number that made your eyes go wide. That number is a lie. Not because it's wrong, because it's incomplete. By the end of this video, you'll understand hotel economics the way an owner actually does, where the money is made, where it quietly disappears before you ever see it, and why a hotel that's fully booked every single night of the year can still be losing money. Because the danger with hotels was never buying the wrong one. It's buying the right one, for the wrong reasons, and finding that out 3 years later, once the debt is already signed. Here's what's coming. Before you own a single room, you're already down 8 figures. And if you think the equity check is the hard part, you're about to find out it's just the entry fee. A 120-room select service hotel, think a clean, mid-tier property off a highway exit, not a resort, runs somewhere between $150,000 and $250,000 per room just to build. That's $18 to $30 million before you've sold a single night. Go upscale or full service and that per room number can double or triple, because now you're building restaurants, ballrooms, and a lobby that has to look like money. Then the brand shows up. If you want a recognizable flag on the building, a name guests already trust, the franchise agreement comes with a property improvement plan, a PIP, that can add another 5 to 10% on top before you're even allowed to open. Furniture that meets spec. Bathrooms that meet spec. A lobby redesign, because the brand refreshed its look 2 years ago and you signed on after the refresh. The building isn't the investment. The building is the deposit. The real business hasn't started yet. It starts the day someone walks through the door and decides whether to pay you for the night. So now the doors are open. Here's what actually determines whether that $25 million was smart money or a slow motion mistake, and getting this part wrong is the single most common reason hotel investors lose money without ever seeing it coming. Hotel revenue comes down to one number, RevPAR. Revenue per available room. It's not your room rate, and it's not your occupancy, it's both, multiplied together. A hotel charging $200 a night at 90% occupancy is making $180 RevPAR. A hotel charging $300 a night at 50% occupancy is making $150 RevPAR. Same market, same building, the second one is quietly the worst business, even though the rate on the sign looks more impressive. This is why obsessing over how full are we without asking at what price gets owners in trouble. Chasing occupancy by slashing rates can grow the top line and shrink the profit at the same time, because a room sold too cheap doesn't just earn less, it still costs almost the same to clean, staff, and turn over. RevPAR is the only number that tells you the truth. Everything else, the rate, the occupancy, the glossy annual report, is a piece of a story RevPAR already finished telling. Here's what most first-time hotel buyers don't budget for. The brand on your building is not a favor. It's a business, running on top of your business, and it takes a cut of almost everything you do. Kemmons Wilson built Holiday Inn in the 1950s on a simple insight. Travelers wanted to know exactly what they'd get before they arrived, and they'd pay a premium for that certainty. Every major chain since has sold the same promise, and every major chain charges for it. A typical franchise agreement takes a royalty of around 5% of your room revenue, off the top, regardless of whether you turn a profit that month. Add a marketing fund contribution of another 2 to 4%. Add reservation and loyalty program fees on top of that. Then there's the PIP again, not the one-time version from segment 1, but the recurring one. Every 7 to 10 years, the brand mandates a renovation cycle, whether your rooms need it or not, because an outdated property drags down the brand's reputation everywhere else. You're not just running a hotel, you're renting trust from a company that's bigger than you, and the rent comes out automatically, before you see a dollar of what's left. And the brand tax is just one layer. Underneath the revenue you worked so hard to generate, there's a stack of costs that eats most of it before it ever reaches you, and this is the part that quietly bankrupts owners who only modeled the room rate. First, labor. Front desk, housekeeping, maintenance, management. In most hotels, payroll alone consumes 30 to 40% of total revenue. A hotel isn't a building that collects rent while you sleep. It's a business that has to be staffed, every hour, every night, whether 3 rooms are occupied or 300. Second, the fixed costs that don't care about your occupancy, property tax, insurance, utilities. A half-empty hotel still runs the air conditioning in every hallway and heats every empty pool. Third, the reserve fund, typically around 4% of revenue set aside for furniture, fixtures, and equipment, because carpets wear out and mattresses die on a schedule, whether you've saved for it or not. Stack the brand tax on top of this, and a surprising amount of hotels are running at 25 to 35% operating margins on a good year, on a building that cost $30 million to build. Here's the part that turns a merely thin margin business into a genuinely dangerous one. Almost nobody buys a hotel with cash. Most deals are financed with 60 to 75% debt, and debt doesn't care what kind of year you're having. A hotel room is the most perishable inventory in business. A grocery store can hold unsold stock overnight. An unsold hotel room at midnight is gone forever. That revenue simply never happens. Which means when demand disappears, it doesn't decline gradually, it cliffs. In April 2020, national hotel occupancy in the US fell into the low 20s, in weeks, not years. Investors like Barry Sternlicht built entire hotel empires on understanding exactly this, that hotel real estate behaves less like an apartment building and more like an airline seat, and has to be financed and reserved for accordingly. The owners who survive downturns aren't the ones with the nicest properties. They're the ones who didn't overlever a business this exposed to a single bad quarter. The mortgage doesn't pause because the lobby is empty. That's the trap. The debt is fixed, and the revenue is not. So if the annual cash flow is this thin, where does the real money actually get made? Not where most people think. Hotels typically trade at cap rates of 6 to 9%, higher than most commercial real estate, because buyers are pricing in exactly the operational risk you've just watched play out across every segment of this video. Sale value is roughly net operating income divided by that cap rate, which means the two ways an owner actually gets paid are growing that NOI over several years, or refinancing once the property's value has climbed. The annual grind, after debt service, after the brand tax, after labor and reserves, often leaves an owner with a modest return, some years barely enough to justify the risk. The real payday happens once, at the sale or the refinance, when years of operational discipline finally get capitalized into a single number. A hotel isn't really a real estate investment. It's an operating business wearing a real estate costume, and the buildings that make owners rich are the ones run by people who never forgot that. Underscore 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 underscore. Notice the thread running through everything you just watched. The building itself was almost never the hard part. Land, concrete, and a brand sign are things money can buy in a weekend. What actually determined whether that hotel made anyone rich was relentless, hour-by-hour operational skill, staffing it, pricing it, servicing it, night after night, forever. So here's the part that should genuinely surprise you. There's another real estate empire, arguably the most profitable one built in the last 20 years, engineered to need almost none of that. No concierge, no brand loyalty program, no nightly staffing to fill empty rooms, just bare concrete, and a machine. Next video, we're breaking down the economics of Amazon's warehouses, how renting out plain boxes by the square foot became one of the quietest, most dominant real estate plays in the world, and exactly why that model would collapse the moment you tried to run it like a hotel.